Is there a scenario that you could imagine that we can cut this out if you want, okay? But I'd like to ask you directly, is there some black swan, combination of events that could occur that would cause Athena to blow up?
Well, I mean, did they make this? Did this? There's a smart contract risk, right? You're using an on-chain
Sure.
thing. There's that risk. You don't know what you don't know in that perspective. Obviously, they've been audited just like everybody else, so it is what it is. You have the exchange counterparty risk. Exchange gets hacked, or they steal the money. Then you have sort of their risk protocols or margin call systems don't work properly, and so you have a massive market move, either the upside or the downside, and that causes some issues in the market. So I think the risk surface, there's a pretty serious risk there, but they're known. And we've had almost 15 years of experience with exchanges and probably 10 or so with major derivatives exchanges to understand what happens in these sort of situations. And I think that the Athena team has been very clear about, here are the risks that you face, here's how we mitigate them. In the worst case, if funding goes super negative, then people just withdraw the money, right? It's not like you have to sit there and, get your capital eaten away. You can just, redeem and get back your Bitcoin or Ethereum or Solana, whatever, right, from the protocol. So there is an out. It's not like an existential crisis where you can't get your money back.
Yeah. Okay, good. What's up, everybody? I'm Lawrence Linker, and this is the Coinversations podcast, the podcast where I speak to the smartest people that I can get a hold of in the crypto space to get them to share their wisdom and their expertise. Nothing that is said by me or any of my guests is financial advice, and you must do your own research before making any investment decisions. Today, I'm very excited to be speaking with a man that many of you will already be familiar with. Arthur Hayes revolutionized the cryptocurrency industry when he co-founded BitMEX in 2014, a firm that later went on to introduce the perpetual swap that remains today the most traded instrument in all of crypto. Today, he is maybe better known as the CIO of Maelstrom, which is Arthur's family office and crypto's hottest new investment fund. Throughout all of this, Arthur has been a prolific writer and thought leader in the space. He is a mainstay on the Cryptoverse podcast, massive Twitter following, shows up in financial news. He's a headline speaker at major events. And I think for a lot of his biggest fans, we love him most for his extremely popular Crypto Traders Digest blog. I first met Arthur in the gym in 2014 when he had just started BitMEX. And when he explained to me what he was building, I thought, I need to keep in touch with this guy. That said, I don't think either of us could have foreseen the level of success that would come for Arthur. I ended up working for Arthur in 2020 as his chief of staff, where we got to work really closely together and I got to know him really well. In today's conversation, I wanted to focus on the insights Arthur shared in some of his most recent articles, particularly his most recent one called Black or White, where he shares his theory on the economic stimulus plan we're likely to see under Trump's next presidential term and how it will affect crypto prices. We touch briefly on Arthur's ideas on how China is resolving its real estate development crisis before moving on to an article he wrote in October called PvP, where he shares why he thinks that the way startups raise money in crypto is broken and probably changing. And then finish with a brief discussion on how things are going with Maelstrom. As always, I hope you guys enjoy this chat as much as I enjoyed having it. And thank you, Arthur, for sharing your wisdom and your time. Let's join the conversation. Arthur, thanks so much for taking the time to speak with me. I thought I want to cover a couple different things today. Mainly, I want to look at your most recent article, Black or White, and kind of dig into that a little bit deeper. And then I also want to talk about some stuff that you wrote in an article a few articles back, PvP, because I think there was some really powerful insights shared there that I'm not sure if people really caught, and I want to kind of explore that a little bit. And then if we have any time left, we'll just talk about, general views on the markets, how are things going on at Maelstrom, and just, sort of the usual stuff. Sound
Cool.
good?
Awesome.
Okay. Great. So Arthur, your articles obviously are very well read. very well written. They've been a big part of, I think, your success in the space and establishing yourself as a leader, the quality of the ideas that you share, the amount of work that you put into forming and backing up these ideas, I think is really incredible. Um, but if a lot of people out there are like me, sometimes we kind of scan through these. We got a lot of other things going on, and maybe we don't get all of it. So I thought in this conversation it'd be good to sort of dig a little deeper into some of the stuff. So in your last article, Black or White, your basic it's a reference to Deng Xiaoping's famous quote, it doesn't really matter the color of the cat as long as it catches mice, which was, the admission at the time just for him to say like, guys, communist schmommunist, we need to make some money, right? let's
Basically.
figure let's figure out let's get some money, and obviously this it was a big change for China's economic position on the global stage. And you're comparing this now to the US, which is sort of on the opposite end of the spectrum. The US has always said, hey, we are capitalist, but with some, maybe, if we have to have a little socialism, that's okay. And then you further make the distinction between, as I see it, like two different types of socialism. Socialism benefiting, like I see you have on one side putting sort of corporations and people, and on the other side putting certain types of investors, particularly investors that are holding long-term bonds. Did I get that correct?
I nuance it a bit more in terms of income levels. So the quantitative easing or money printing that's been going on since 2008 has mostly benefited those who own financial assets. So the very, top 10, top 1% of the US population. And if you look at Census Bureau decile income gains from 2008 to the present, you can clearly see that those who own the most financial assets have done very, very well. Everyone else has kind of gotten. And so that's sort of the delineation there. It's like, do you own a lot of financial assets? You've done very well in your QE. If you didn't own a lot of financial assets, then you watched your wealth stagnate, if not outright decline from 2008 until the present. And so that's sort of the distinction that I'm making.
Okay. And okay, so let's dig into this a bit because and correct me if any at any point I'm wrong, but it sounds like you're making a distinction between policies that were followed, sort of pre 2020, um, bad girl Yellen policies, and then what you expect from like Besant going forward, which is kind of more like what Trump did in his first term.
Well, I guess remove the people from it. It's the orthodoxy was if there's a deflationary event like 2008 and banks are going bust, then you flood the system with quantitative easing, Federal Reserve, money printing that primarily goes to raise the price of assets and make sure that banks are solvent because their loans are backed up by bonds and stock prices and stuff like that. And the point was that really only benefits those who own financial assets, whereas everybody else doesn't really do much. And so you basically increase the amount of debt and you don't increase the amount of economic activity alongside it. And so that's why I showed a chart of debt to GDP rising from 2008 to 2020 quite substantially. And then COVID hit and Trump happened to be president at the time. I don't think the response would have been that much different if it would have been a Democratic president. And the response was, okay, we're going to shut down the US economy. How do we keep people from rioting? Well, let's just give them a check. And so we give a check to everyone. And so this is the first time that, using Ben Bernanke's words, helicopter money was used in sort of the United States in this fashion. And what happened? You gave money to people who had a propensity to spend because they're poor. And they went out and they bought stuff. They bought cars, they bought wash machines. If they didn't have to buy anything, then they went and bought financial assets. But if middle class, upper middle class person, you had things that you wanted to buy and you went out and you bought those goods. And obviously we saw the port congestion in the United States, the goods inflation, stuff was sold out across the United States because people had, for the first time in a long time, disposable income and they had things they wanted to buy. And so you had economic activity quite rapidly grow, right? You only had a recession for, I think, one month or one quarter, whatever it was, April to September in 2020, and then it was off to the races in terms of U.S. growth because companies expanded production, banks lent them money, everybody was doing stuff because the poorest 90% of the population now had the availability of funds to buy stuff and to consume services. And so you actually saw the economic growth accelerate faster than the amount of debt that was created, which decreased the leverage of the US government. And from the US government's perspective, ignoring inflation, that's a very, very good thing, because now that they're less levered, because they printed money instead of handing it to rich people who basically did nothing with it. They handed it to poor people who bought stuff and continued to make the economy grow. And so that's the dichotomy that I'm drawing. And then back from 2022 to the, kind of the present, the bond people revolted. They said, no, Jay Powell, come in here, go back to the way we used to do things. And they flooded the system with money, the Treasury and the Fed together, and rose financial asset prices, but didn't really do much for economic growth, and sort of debt to GDP rose again. And so my point is that, and these two things happen under a Republican and Democratic presidential situation. So it doesn't really matter what party is in power. And my thesis is that Trump and Besson, who now has been confirmed as his choice for Treasury Secretary, have been very clear about the policy that they want to run. They want growth to accelerate quickly so that the U.S. government deleverages. And so then the rest of the essay goes out to point out exactly how you can do that and how it was done during COVID. So there's a point in period of time, very recent, where both a Republican and Democratic president were very successful in creating economic growth and deleveraging the balance sheet of the government. Yes, I know inflation was a problem, but I think that's just going to be something that they tolerate to get the goal of let's deleverage the U.S. government.
Okay. But you're not expecting in the next phase any kind of like direct payment stimulus. That's not the method that
No,
they're going to do it, right? How are they going to do it?
they use the banking system. So if you look at, I think there was 3 bills, major with the CHIPS Act, which is semiconductor production. There was the Inflation Reduction Act by Biden, and the Green New Deal. And essentially, there were overarching policy goals. The CHIPS Act, Biden wanted U.S. people to build chip factories in America. And obviously, it was uneconomical to do so because of high labor costs and regulations and whatnot. So no one did it. So, okay, let's give some government money, to subsidies and tax breaks, so people build semiconductor fabs. TSMC and Intel, they're starting to build fabs in the Southwest of the United States. They get these credits. They take it to the bank. They say, hey, look, because we qualify for this program, can we get some funding? The bank says, oh, of course you can. So the bank is willing to lend because you've taken away the risk of default, because the government's going to come in and give them subsidies to make an uneconomical business economical. And so now you've created jobs. Now you have the ability to bring, these critical resources onshore from the U.S. perspective. And so that's how I think that they will incentivize growth, incentivize companies to build things in America, incentivize companies to hire American workers, even though they're more expensive and probably less productive than other countries' workforce. And it all starts with a government subsidy or tax break that a qualifying company can take to the bank and say, look, I qualified for this government program. Could I have some financing to build a plant or hire some more workers or whatever? And when a bank creates a loan, it also creates a deposit. And so it grows the money supply and increases economic growth. And that's what I show in sort of the counting T charts throughout the essay.
Right. And so what I interpreted as the point you're making that I thought was most surprising for me, because if you talk about the way people like usually talk about different political parties and their preferred methods of economic stimulus, you talk about trickle down economics. Let's create tax incentives and give tax breaks for the corporations, and it'll trickle down to the people, versus let's provide largesse in various forms to the people directly, and it'll trickle up to the greater economy. And what I'm interpreting from what you're saying is that actually these two policies end up with the same result. On one hand, you can either pay off the people directly, or you can create those incentives on the corporate level. Either way, these things will be stimulating for the economy. Am I reading that correctly?
Yeah, at the end of the day, you want to create induced demand. Whether you hand people a check or you give a company a tax break or a subsidy, you want them to do something, like, as opposed to quantitative easing as traditionally practiced, which is I'm just going to take away safe treasury bonds and make banks and corporations go and buy stocks or do buybacks, and then only rich people benefit. The other way money's still being printed. It's just who's it going to? It's going to a company that's going to build something to hire workers. It's going to pay them, or it's going direct payment to somebody who's going to buy a washing machine or a truck or whatever. And so that is going to induce the company to produce more stuff, go to the bank, get a loan. At the end of the day, you want the banks to lend and create more money because they feel comfortable that the economy is growing. There's demand for these products, for companies coming to them looking for loans, or, hey, I'm willing to give you a personal loan or a bigger credit card limit because I know you have a very solid manufacturing job that's going to be there for a while because your company's profitability is guaranteed by the United States government.
Right. Yeah. Very interesting. So where we stand now, Bitcoin is kind of like it's fallen back a little bit. It looked like it was going to cross 100K, but it's still way up. I mean, we've seen just a massive amount of growth from Trump's election just a couple weeks ago. You seem to feel that this result was going to come like, regardless of who got elected president. Do you feel like the rise in price of Bitcoin since the election was decided is a reflection of investor sentiment that Trump was going to make an appreciable difference?
Well, I think there's the first thing is that he kicked Kamala Harris's ass, right? And so that removed the specter of civil unrest. There was no question
Yes.
that he won,
Okay.
right? So
Yes.
that's good. If Kamala Harris had kicked his ass, that would have been good too. There's no question that she won. The worst
Okay.
outcome was sort of in the middle. We don't know who won.
Yeah.
Either side accepts the result, and then you get sort of civil
Sh-
unrest. That's
Sure.
that was removed by Trump's landslide victory. And then the
Yes.
second is obviously crypto people think that he's going to be positive for crypto regulations. We'll have to see on that one. And then you know, I think that the real thing is that he has been very clear about the economic policy that he's going to run, and Besson has been very clear as well that they are going to be a pro-growth situation. And I think that Bitcoin is teasing out that pro-growth means we're going to encourage massive expansion of bank credit to industries which we think are worthy of receiving credit, similar to how China does it. That's my interpretation of the result. It's a combination of all three of those things. Kamala Harris would have done the same stuff. I don't think her economic policy was very clear in what she was talking about during her candidacy. But if you look at the last 4 years of Biden, Janet Yellen at the Treasury kept pumping money into the system to make sure the market went up. So I would imagine that the Fed would be cutting rates in December. There would be even more money being printed because, they were firmly in the Democratic camp. It might take a bit more time for Trump to get some of the similar treatment because he's got to replace all these officials and get people loyal to him. But at the end of the day, the result's the same.
Yeah. Interesting. Yeah, I didn't consider that the decisiveness of the Trump victory in a sense sort of clears the path where it feels like something is going to happen in a pretty straightforward way rather than if it was like a super close or disputed election. And certainly if there was less convincing wins in the House and the Senate as well, there's this idea that the Democrats have the opportunity to obstruct without losing public support. But in the way it is now, the Democrats are to use a word you love to use, the Democrats have been heavily cucked at this point, and we'll probably follow along with whatever happens. Very interesting. Okay, so let's talk really quickly about yeah, something I see you're tracking kind of towards the end of the article, which is about deposits and what's the significance of tracking the bank deposits as a telltale metric for this.
So if my theory is correct, then we should stop looking at the amount of credit that the Federal Reserve is creating through quantitative easing and the size of its balance sheet. And we need to start looking at the banking system as a whole. How much credit is the banking system creating? And so if you want to have a proxy for this, and this is definitely not an exact science, not even, the Fed or the Treasury knows how much dollar credit there is out there in the world, then we need to look at the two places where banks essentially emit credit. The first is reserves. So the reserves held at the Fed. The Fed has direct sort of influence on that based on its operation of buying and selling bonds from primary dealers. And then you have what's called other deposits and liabilities, another line item reported by the Fed, and every other major central bank has a similar metric, which shows, okay, well, how much money is out there that the banks have created. And so sum these two together, you get a sort of a proxy for a U.S. bank credit. And I posted a chart, and 2020 looked like bank credit led Bitcoin. Obviously, bank credit pumped when they handed out checks to everybody, created deposits in their accounts, and they went out and bought stuff. And now I believe that Bitcoin is running ahead of bank credit, saying, okay, we believe that Trump and Bessent are serious about what they say about how they're going to reflate the U.S. economy. And so Bitcoin is running ahead of bank credit. And you can look at the chart and
Mhm.
see that Bitcoin's rising, and bank credit's kind of flatlined for
Yeah.
the time being.
How could this go wrong? What would be something that you would see in the data to suggest that either the correlation you're expecting is decoupling or that, Trump and Besant are not going to behave in the way that you expect?
We'll see the types of bills that they attempt to pass, right? Is he serious about bringing back American jobs? There's no way that you can bring back American jobs. The reason why companies left America is because it was unprofitable to do so. If you go to the eastern seaboard of China, it is miles ahead, more productive than the United States. They produce better stuff at a cheaper price. And that's because a very concerted policy from the top down to make themselves a manufacturing powerhouse. And of course, a profit-seeking multinational company is going to go where they have the cheapest workers and the best quality stuff, and that's why they're all producing things in China. And even when you say that, oh, it's cheaper to do Vietnam or Bangladesh or Mexico or some of these other countries, they still can't get away from China because it's just so interconnected and so productive in terms of how they've set things up. And so if we see that Trump just says, fuck it, we're just going to let China produce our stuff, okay, then I could definitely see a situation where you're not going to see a resurgence of the amount of credit issued, because now you're going to have a hostile Federal Reserve until 2026, I think, is when Powell's term is up. So Powell was
Mhm.
definitely in the Kamala Harris camp. He thought Trump was a devil. He's definitely not going to do what Trump wants him to do, which is lower the price of money and increase the supply. So it's got to come from the Treasury. It has to come from industrial policy. It has to come from legislation in terms of the types of bills that he's going to pass to get American companies or even foreign companies to build productive capacity in America and then receive bank credit at favorable rates to do so. So we'll see in
Mhm.
the types of things he tries to get through the legislature.
Yeah, interesting. Okay, I do want to talk about China for a little bit actually, since it came up. Before that, Arthur, we're going to take a quick pause because this feels like a great time to hear from our sponsor. Ready for a real bank alternative using crypto rails? Meet Cast, the ultimate card to spend stablecoins and soon crypto at over 150 million merchants. Available to over 100 countries, it takes just 3 minutes to set up. Top up using USDT, USDC, or USDE from supported networks like Solana, Tron, Ethereum, Polygon, and more. Start spending instantly using Apple or Google Pay. Splitting a bill? Send money through WhatsApp or Telegram. Need to get paid? Get a virtual USD account and receive funds in your Cast account as USD stablecoins. Cast is the first true bank alternative for the globally mobile crypto economy and remote workers. Premium metal cards or Solana cards earn up to 12% in points, and Coinversations listeners get $10 in USDT for your next coffee on Cast. Just download the app using the link in the show notes. All right, Arthur. So China came up. I wasn't originally planning on talking about this, but I guess I would like to know a little bit more about the China housing crisis, how that's shaping up. You've written some articles about this as well. Why do you think that this is going to sort of end up being accretive to Bitcoin?
So at the end of the day, China needs to reflate its economy. They have a problem. They built too many houses. There's lots of charts that show it's the biggest housing bubble that we've ever created in human history. And, the leadership, even before she recognized that if we have a whole development economy geared towards housing that's leveraged, obviously not a good thing. It gives power to our adversaries, the United States being the chief one, and their ability to inflict economic pain on us by manipulating sort of the global financial conditions, exchange rates, and whatnot. So there's always been this drive to how do we pop this property bubble without having too much collateral damage. She thought he had the political will and the economic window to start doing that during COVID, and they popped their property bubble. It's probably worse than they expected to happen. And the big issue is that in China, as opposed to most other places, when you buy an apartment, you put down the full amount of the money before you get the apartment. And so you have all
Mm.
these millions of people who paid in full for their apartments, but the property developer has either gone bankrupt or does not have the ability to access credit to complete their unit. And so it's not just a question of money. It's, hey, I paid for this apartment. The person who's supposed to build it isn't in business anymore. So either A, the Chinese government needs to get into the business of building apartments, which obviously they don't want to do, because if you build it shittily, then you're going to have people angry at you rather than the property developer. Or they need to figure out a way to get as much credit as possible to property developers and make sure they just build apartments and don't do anything else, which is obviously a problem because once you unleash the spigot of credit, you really can't control where it goes in most respects. And so that's sort of the issue that China is facing. And I think that at the end of the day, they will try to keep their economy on life support as long as possible without reflating in a massive way until they understand exactly what's going to happen with tariffs and any sort of other things that the U.S. might do once Trump and Bessent get going in office next year. But at the end of the day, they're going to have to print money because they're not intimidating or that insinuating that they're going to follow an Argentinian model, which is, okay, you made a bad bet and you have to suffer the consequences. Banks go bust, people go bankrupt, companies go bankrupt, local governments go bankrupt, and we cleanse the system of the credit. That's not what's going to happen in China. They're going to find a way to print money. And we've started to see that the People's Bank of China, the Chinese central bank, has started doing a little bit of quantitative easing. They've started to buy central government bonds. You have the government allowing the local governments to raise debt to invest in directly into the banks. So they're going to recapitalize their banking system to let them issue credit once again and get the growth in credit high enough to generate the growth necessary to help them grow their way out of this situation.
Yeah. Pre-sales was a big part of the '08 financial crisis in the US as well, by the way. But it sounds like it's a really big part of China. There must be a secondary market for housing as well, though.
There is, but if you don't have the house built yet, then no one's going to want to buy it. That's the problem. If you have an already completed unit, yes, the secondary sales of already completed units, that's fine. It's the primary market where I bought a house, I don't have it yet, and I'm questioning whether the developer will be able to finish it. And so it's very difficult, pretty much impossible to offload that contract to somebody else. Well, I'm not going to get this house. Doesn't matter what I
Sure.
pay for it. It's not a question of money.
Yeah. So, okay, yeah, it's a liquidity issue to an extent. Is that
Yeah, instead of being it's a bank run on developers where the issue is, can you build this house or not?
and what are you seeing in terms of how does China and PBOC intend on getting this money to the people to sort of get, the system working again? Does their system work similar to how the US works? Like what's the mechanism by which they, backstop all of these
They'll allow the banks to lend to the local governments and the property developers again to get the credit flowing, and then they'll complete the projects. That's the easiest way to do it. Obviously, there's a big externality, which is they just keep encouraging the same thing that they were afraid about in the first place. So that's the decision tree that they're trying to navigate.
And do you have a sense of what, like quantitatively, how much currency debasement or like new money creation are we looking at for them to be able to solve this problem?
I don't have it's trillions of dollars. I don't really have a specific number
Yeah,
off the top of my
but
head.
it's quite significant, right? We're talking about the second largest economy in the world,
Yeah,
billion.
and they're the most indebted. I think I looked at a chart the other day. They will cross the total amount of debt issued in China will be equal to world GDP in like the next 5 or 10 years, something like that. So it's insane. And obviously,
Yeah.
they created all this debt within the last 20 years.
Interesting. Fascinating stuff. Arthur, whenever your essays are like a freaking masterclass in global politics and economics every 2 weeks, man. But there was one article that you wrote recently that like really hit me like a ton of bricks. And I wonder if other people felt that way, focusing on a much smaller issue, which is about how builders in the crypto space raise money and capitalize on the tokens that we generate. So this, I'm of course talking about the article PvP. And maybe just to summarize for everyone, what I took from it was that you're basically saying that, this trend that we've seen in the last couple of years of token launches that are very, or just raises in general, very high FTV, very low float. Maybe that's just not working anymore, and there's like another path. Is that fair to say?
Yeah, very very high level.
Yeah. Can you just expand on that for a little bit? Like why that what does that mean and why that is?
Well, if you take Bitcoin, Ethereum, Ripple, Cardano, some of the earliest tokens are all probably in the top 10. And you look at, well, Bitcoin number one never did a pre-sale. It was you mined it and it gained value over time. Obviously, that's a very, very slow way to develop a network, but it's obviously the strongest way you can do it. Pure grassroots. You're not selling anything. It's participation equals, you know, ownership of the network. That's the best way to do it. Takes the longest, which is why most funders don't want to do it. The second way is, the ICO, right? So I have a website, I have a team, I tell the world, hey, this is what we want to do. We need you to subscribe and give us some Bitcoin originally. Now, and during 2017, it was Ether. And we're going to take this money and we're going to execute on this white paper that we put out there. And here's a token that we're going to issue you. Maybe we'll issue it today or tomorrow, but you buy it right now and you give us the money, we go and we build it, right? And that was the whole ICO craze. And the good thing about the ICO craze was that because it's just super speculative, the price that you were able to get in on the ground floor was very low. Obviously, the majority of ICOs are zeros or close to zero, but that's the game that we're playing. And so obviously that had a mania in 2017 and that fizzled. And in its place, we have the current system, which is, okay, I'm a project, I need money. I don't want to go and put out this thing to the wider public. I want to just sell it to very rich people. So I'm going to go and pound the pavement in, Silicon Valley and Beijing and London and whatever, and try to get a small coterie of crypto focused venture capital firms to give me money. And so I create this whole structure. I have this equity company, and then I have this fake foundation, and I issue these warrants tied to equity, all in a way to get around all the investment mandates that these venture capital firms have. And so this is the sale of future token agreement that was created to essentially sidestep all of these issues. And so the VCs obviously have an incentive to do what? To mark up the value of their illiquid investments. They don't want liquidity because liquidity could be good or could be bad. But if I just keep having a private round and marking up the price, then I get to show positive past performance. I get to invest money. I get to charge my management fee, and then I get to raise the next fund based on illiquid, untested in the market stuff. And that's essentially what we have now. And then at the end of the road is, hey, I'm going to list on an exchange because I've raised 5 different times. And the last round was at $500 million or $1 billion FTV. Then it has to be higher in the primary market. When I go on the exchange, I list on the exchange, I give a bit of an airdrop. Everybody dumps it because it's overvalued, and then the thing dies. And that's where we have 2023 to 2024. We had abysmal returns. If you were a retail person and you bought into the listing of some of these new products, regardless of how successful the project was.
Yeah. Is that, Arthur, is that really what's happening? Like the VCs are going to new investors, showing these illiquid returns, like, hey, we're up,
Yeah,
this.
absolutely.
Yeah.
They're not lying, right? It's up
Yeah.
to you as an LP to like
Yeah.
understand the game and how it works. But there was a price. Certain people paid
Yeah.
this for it. It's not they're not lying. It's just that
Yeah.
it's 5 versus the entire internet who's valuing this
Yeah.
project.
Yeah, it's quite crazy. And obviously I have a unique perspective on this because I was in this recently. I raised venture money, and I know the pressure to defend your valuation in subsequent private rounds and whatnot. Um, do you think that, but it seems like the trend is changing, and in kind of an obvious way, right? Like the market is really not into these low float tokenomics in a way that they seem to think was okay before. How do you think that the industry is going to respond to this?
We're gonna go back to ICOs. So we've proven that meme coins are successful. Pump that fund is the most successful probably application of this cycle in terms of revenue generated and engagement. I mean, they're so successful. You have people on like trying to, posting videos of them killing people and whatever on the internet. Whether or not that's real or not, who knows? But at the end of the day, it's got the long tail of retail engaged and interested in interacting with the technology. Anyone can launch a meme coin. They're, fair launches, 100% supply is out there, and then you just trade it, right? It's a Verdict on the virality of a particular meme and how strong a community is. So we need to get back to that in terms of raising for actual projects that are trying to do something. Go back to the way that we used to do it during the ICOs. You have a team, show us where you worked or what you did before, show us GitHub commits, show us your white paper, does it make any sense? And then this token out there immediately. Raise money and then list the token and then let the market do price discovery on what they think the future holds for your project. And yeah, I understand that you might need to keep a certain amount of tokens back for your treasury and to lock up your team tokens, but 70-80% of your supply should be out there immediately. And that's going to really engage retail, because if you're able to connect with the retail crowd and offer them a product that makes sense and a story that is believable, then they're going to buy your token. And if you're successful, you're going to make a poor person middle class, a middle class person wealthy, whatever. People are going to ascend the economic ladder, and those are the most vocal and engaged proponents of
Supporters, yeah.
supporters of what you're trying to do. And that's how you get an XRP army or the people who own Cardano. I picked those two projects because they're complete bullshit. They don't work. They don't do what they say they're supposed to do. It's been almost a decade. Ripple has not been used to transfer money, and Cardano has no smart contracts. So complete dog shit. Doesn't matter. They're still top 10 coins. Why? Because you made their communities wealthy along the way, and they're never
Yeah.
going to desert you.
Yeah. That's man, that's fascinating. I guess what I have a hard time wrapping my mind around is, so like there are a lot of projects which require a lot of capital. There are different strategies, right? You can use the sort of bootstrap strategy,
We can
which
raise
is
as much as possible. I mean, EOS raised $4 billion in an ICO. ICO doesn't mean you raise little. Does not mean you don't raise a lot of money. You're judged based on the strength of your team and the strength of your idea, how you're able to communicate it, how you're able to hit
yeah.
like a particular meta narrative. So yeah, you can, if you have a capitally intensive project and you go out there, there's definitely ways for you to raise billions of dollars worth of crypto. It's been done in the past, and obviously the market cap was much smaller in 2017 than it is today. So if you were a well-regarded team within the community, I don't think that the ICO means that you raise less money. It just means you have to do more work to convince people of why they should believe in you over the long term.
But you don't have the opportunity to iterate, right?
Of
So
course you
because
do. It's just a token, right? How the token is used in the product and what the product is could change immensely between what you put out there in a white paper and what is delivered, right? But as long as you're communicating with your community in real time, hey, this is the problem we ran into. Hey, this is how we're going to change things, right? You're being very communicative,
yeah.
engaged. That I think the community will forgive you for that, and they'll continue to hold your token.
What
No
I
one's
mean
expecting you to know what the future is supposed to hold.
what I mean by iterate in this sense is that like a lot of startups, whether in crypto or in traditional tech world, they raise a certain amount of money based on kind of where they're at in terms of their development, and then the idea is like, look, using this money, give us a chance to build something bigger that will justify a higher valuation. Whereas if you do an ICO, sure, you're going to keep something for treasury, but in order to not have that low float situation, you're basically giving away a huge amount of your tokens that you're really not going to get back unless things go badly anyway, right?
Or you
So
have, I mean, I think you have to start out with the perspective of I need to build a product that people are willing to pay for, which is not where founders are
yeah,
today. It's I need to build a product that the VC is going to give me money for. And so that product is not usually doesn't align with product market fit. It just aligns with what the VCs feel good about investing in. So when they lose their money, they don't lose their jobs, right? So
yeah.
that's
Can
the
I?
metric. And so I think if you are beholden to the community who now owns your token, you're going to build a product or come to the market with an idea of a product that is going to have usage. Your token is going to be used in some way. There's a flywheel effect. Hey, you're willing to pay for this service or product that I'm going to offer. And that's how I'm going to fund myself as a project going forwards in an economical way versus, hey, the VC said I need to pump my Twitter followers. So I went on Fiverr and, paid some Bangladeshis to click on a button. Oh, I have the Twitter followers now. Can I get another valuation bump? Like that's what we're doing today.
Yeah, or we're at least, yeah. No, I hear you. I guess I feel like there's another side to this because I want to push back a little bit. I think you're much smarter than me. You have your finger on the pulse of this much more. But just for my benefit to understand, um, there are projects that we've seen, certainly in the traditional tech world, right? And it's like very Silicon Valley, kind of like farcical in many situations. But there have been examples of projects who said, look, we're not going to worry about profitability or even revenue right away. We're just going to focus entirely on scale and growth, because once we get past a certain point, we basically own this market, or we have a certain size where we can exert our profit taking ability. And we have examples of very successful companies that have done very, very well for their investors using that model. If companies in the crypto space, well, I guess, is there going to still be the opportunity to grow in that way in the crypto space if the culture becomes one where high float ICO early in the project's development cycle?
I don't know. I mean, I guess I would challenge you to name companies. You probably can name probably less than five that have done that versus the.
I could probably give you five.
And
Yeah.
I'd say that fine if you want to be the Netflix. I mean, Uber's never made money on a
Yeah,
on a net basis. Netflix, I don't know, have they made more money than they raised? Probably not.
maybe not.
Tesla, like no. So again, you might cite some companies that are worth, I don't know, however many trillions of dollars. That has nothing to do with their profitability. That's all passive indexing and a lot of other factors that go into why they're worth so much money. But at the end of the day, their product from a life to day perspective, they have not made more money than they've raised. And so is it actually a real product that we should be sort of championing as a human society? I don't know if that's a philosophical question. I'm
Yeah.
not worried about that. If that's what we have to get rid of in crypto to get more alignment between the retail and the world and the tech products that they use and get them ownership, I'm perfectly happy to say that companies that net lose money from life to date from investment versus the profitability they've made at the end of the cycle, fine. We don't get Teslas and Netflix, but we get strong companies with good cash flows that elevate people out of their, current economic state to a better one. I'm okay with that.
Yeah, dude, that's a very principled stand. I appreciate it. I'm glad we went through the process of clarifying your thoughts on this. As an investor, though, isn't it a little bit limiting for you, because obviously you make your returns on the growth of the valuation from the time that you invest until
I mean, the question is, do I want to have an Ethereum or do I want to have a trying to pick an eigenlayer? Let's put that
yeah.
one out there, right? I'd rather have Ethereum all day long.
Sure, that makes sense. Yeah, fair enough. Okay, I think we can close that out. I think that was a super interesting topic. I want people to think about this more, because I do think that I think we're going into a different phase. I don't think that these low float, high FTV tokenomics are going to work anymore. And I think that what we'll see, again, tell me from your perspective if I'm right about this. Even serious projects that are trying to do like important real things are going to follow more of like a meme coin kind of funding model. It seems to be that there's something there, right? Bring the community in super early, take them with you through the whole ride, which is back to the ICO roots to some degree, as you say. Okay, let's talk about Maelstrom. So Arthur, Maelstrom has not been around for a long time. I think it's, what is it, a year now, a year and a half?
Yeah, a bit. Yeah.
Yeah, but already, I mean, you guys are like, you throw the best parties. You're you're showing up on a lot of different sources as being cited as like, a fun to watch. Are you pleased with how Maelstrom is going?
Absolutely. I mean, it's great. We started investing during depths of the bear market, late 22, early 23. I think we missed a few, missed Eigenlayer and some other projects, pumped that fun. But I think we've hit most of the major narratives and most of the most successful projects of the cycle so far. So I think hats off to Akshat and his team for what they've been able to do. They do all the work. I'm just here on podcast, hype manning for them, but
Yeah,
the
yeah,
real work is done by
yeah.
those who are not so visible.
Yeah. Um, I mean, I think it does offer a unique advantage to have somebody with your experience and your profile as a resource for
And we don't have
these.
LPs, so it's different. Like, I don't think you can compare Maelstrom to like, a traditional venture capital firm. Like, well, I shit on them. Like, they have the constraints and they're operating within them. If you are going to raise other people's money, then these are the things that you have to do. And the ability for you to operate in this space is going to be different than me, which is just my money. I don't care what Bloomberg or Wall Street Journal says about what I invest in. So I'll do whatever the fuck I want to do. I'll invest in whatever I want to invest in. And, we just care about making money, not raising another fund. So it's a different sort of set of criteria for how we judge ourselves than a traditional venture capital fund. So I think it might be a bit unfair to compare what Maelstrom is doing with some of the, very high profile crypto VC firms.
Yeah. Do you think there's a future where you guys do take on LPs?
No, I love the way this company works. When you start taking other people's money, it's a whole different type of reporting and obligations and all this kind of stuff. And what's the point? No, there's
Yeah.
no upside for us.
Okay. What about other like what are some other ways that you see you guys growing, changing, evolving?
I mean, we're just here to participate in the space, right? Hopefully, we're able to provide capital at a very early stage to some of the most impactful projects on sort of this goal of decentralizing everything within the world. So I don't really have a, Maelstrom needs to be this much AUM or we need to make this much money. I mean, that's the one hurdle that we have is, are we going to generate more returns than owning Bitcoin and Ethereum? Because if we can't do that, then why we shouldn't be doing our jobs? So you just put the money in a wallet and, go to the beach.
Is there is there a particular time scale that you're focused on?
No, I think when you put sort of timescales on things, then you start getting into artificially limiting yourself and how you judge yourself. It's compounding returns, right? So there's no date in mind, and I think that's how individual investors should look at their own finances. But obviously, it's different when you're in an institutional framework because you are sort of geared towards annual arithmetic bonus cycles, which is great for you as the fiduciary, but is absolutely terrible for your clients.
Yeah, interesting. And how do you guys what would you say so you guys have had like a really high proportion of winners in terms of investments that you've made. What proportion of that do you think comes from I mean, I'm imagining there's a few things you have going for you, right? Like one is like people want Arthur Hayes on the balance sheet, like or on the cap table, token pool, whatever, just because it's Arthur, right? I think that definitely helps. And then Akshat, I think, I know from conversations back when we worked together at BitMEX, super talented guy, very smart about the companies that he's investigating. Um, where would you say like what is it that you think you guys are doing that's generating like the most for you in terms of your competitive advantage?
It's obviously the publicity helps because we get into deals late that maybe we wouldn't otherwise get into if we are another no-name fund. But the second is that very high discipline on price. Price is what you pay, value is what you get.
Mm,
So Outshot has a ceiling of how much he can pay for a deal. It's
hmm
very low. And we routinely do not engage with projects where we can't get the valuation that we want. And
mm,
so I think being very disciplined on price makes sure that you don't invest at. We don't know when the cycle ends. Obviously, I think we're just at the beginning of a massive bull cycle, but I could be wrong, right? But at the end of the day, we look at the statistics on where a project launches in terms of its FTV. If we're able to stay well below that in terms of what we paid to get in, then even
mm,
if we're completely wrong on the thesis and the project's a complete piece of shit, we still should be able to get our money back. And
yeah.
so that is the number one game for us is, capital preservation to be around to get the 1 out of 100 or 1 out of 1,000 Ethereums and Athenas and Pendles and all these types of projects that are the ones that are going to make your fund, but you need to be around. And obviously you're not going to be able to find those 100% of the time. And so limiting your downside risk by paying the lowest possible price possible, that's the most important thing, at least from my perspective, and how we make sure that we're going to be around in every cycle to get the 1 to 5 projects that are significant.
Do you guys get special discounts from projects?
I wouldn't say we get special discounts. We do things to help people out, and they reward us by giving us better economics.
Yeah, fair enough. Well done, Arthur. We're almost out of time, so I'm going to just ask two more questions, okay? One, so there is one project in the Maelstrom portfolio that I think really stands out in terms of its success. I'm of course speaking about Athena. I often tell people, by the way, when I'm talking about my experience working with you, about how obsessed you've been with this idea of sort of capturing the base trade and as some kind of like singular instrument, for a while. It's incredible to see this having been done in the Athena project so effectively. And Athena is really kicking ass in the last 3 weeks in particular. From your perspective, what are what does the future look like for Athena?
I think that Guy and his team have probably been the best team I've seen executing from a limited amount of time. I think they've only started building this 18 months ago, maybe max, something
Yeah.
like that. And they've been the fastest growing stablecoin in terms of assets under in circulation. And so I think the stablecoin industry is extremely difficult. It's a winner take all market. It's basically an oligopoly between Tether and USDC. And sort of now we're presenting a different risk model. None of these are risk free. Athena, which says, okay, instead of taking making a risk, we're going to take centralized exchange counterparty risk and settlement risk on their derivatives and keep the risk inside of crypto to offer this dollar linked coin or synthetic dollar, as I like to say. So, Guy has been doing the hard work of convincing all the major sexes indexes that Athena should be USDE should be collateral within the system, meaning I can take my USDE to say Bybit, for example, and I can use that to trade a perpetual swap, or I can use that to margin trade, or I can take USDE to some of the largest OTC brokers in the space. And instead of using Tether or USDC, I can now use USDE. Now, these are the things that's going to make Athena very sticky and almost impenetrable from competition, because as an exchange or market maker, you're not going to do this for too many things because
Mm.
it's operationally a pain in the ass. But what Guy and the team did very early on was make sure that they got an investment from all the major sexes and all the major market making firms. Obviously, I helped out with introductions in some of those situations, but that's the strategy. It's a community owned synthetic dollar. It's not one person's product like it is for Tether and USDC. And all the community can benefit, whether that's the exchanges, the market makers, the traders, or just somebody who wants to earn this yield that's endogenous to the crypto ecosystem. So that's why I think Athena is my bet for, I could definitely make it into the top 10 and get up there with Tether in terms of market capitalization, because I believe that there should be two options. One option is, okay, we're going to trust the US dollar banking system to help us create this dollar, or we can trust ourselves. And I don't think that, one is better than the other. It's just different sorts of risks. Choose what you like. Obviously, I'm more prone to taking the risk of the people who believe in crypto like myself rather than the banking system that wants to destroy us. But that's just my philosophical bent.
Yeah. Is there a scenario that you could imagine that this is we can cut this out if you want, okay? But I'd like to ask you directly, is there some black swan, combination of events that could occur that would cause Athena to blow up?
Well, I mean, did they make this? Did this? There's smart contract risk, right? You're using an on-chain
Sure.
thing. There's that risk. You don't know what you don't know in that perspective. Obviously, they've been audited just like everybody else, so it is what it is. You have the exchange counterparty risk. Exchange gets hacked. Do they steal the money? Then you have sort of their risk protocols or margin call systems don't work properly. And so you have a massive market move, either the upside or the downside, and that causes some issues in the market. So I think the risk surface, there's a pretty serious risks there, but they're known. And we've had almost 15 years of experience with exchanges and probably 10 or so with major derivatives exchanges to understand what happens in these sort of situations. And I think that the Athena team has been very clear about, here are the risks that you face. Here's how we
Yeah.
mitigate them. In the worst case, if funding goes super negative, then people just withdraw the money, right? It's not like you have to sit there and, get your capital eaten away. You can just, redeem and get back your Bitcoin or Ethereum or Solana or whatever, right? From the protocol. So there is an out. It's not like an existential crisis where you can't get your money back.
Yeah. Okay. Good. Last question. Kind of building off of this stablecoins. It's stablecoins seems to be like a huge part of the narrative right now. Everyone's talking about stablecoins, using stablecoins in different ways. Seems to be a crypto use case that people are really into, and I think it makes a lot of sense, right? We also hear a lot, of course, about AI constantly, RWA. What are the other sort of development areas that you think are exciting or are going to play a big role in the next cycle?
I mean, AI is definitely going to be huge. The question is, how will an AI agent use crypto and this capital formation process? And maybe it's a communication protocol. I don't think we know, but there'll be a use case. What that is, we can just throw our chips on the table and hope we hit one. I think RWAs are bullshit, because for most cases, it's usually gets to play on interest rates. And so if we believe that governments are going to either reduce the rate of interest or they're going to do yield curve control where they fix the rate of interest, even though it should be higher to compensate for inflation, these protocols don't make a lot of sense. What you should be doing, instead of putting your money in RWA, if you want the yield, go into something like Athena, which is giving you the endogenous yield of crypto, which is the best performing asset in this inflationary environment. Or you should just be buying stocks, right? You shouldn't be in a product that is essentially a long government bond, because that's the worst thing you could be investing in right now.
Yeah. Okay. Fair enough. Arthur, we are out of time, my friend. Thank you so much for being on the Conversations podcast. You are by far our biggest, most influential person that we've had on it so far. I hope this will make it easier to book other people closer to your caliber. And not that, God, I sound like I'm putting down our previous guests, but I think this is a big moment for us, is what I'm trying to say. And thank you so
Thanks for having
much.
me.